So what happens when the dollar wakes up? Commodities get selective and equities start rotating instead of rallying. Well, you get a market that's not necessarily panicking, but it's definitely not relaxed either. So currently, when we look at markets, think less party mode and more checking for exits. Good morning, everyone. My name is Francois. I'm your market analyst here at ATFX Africa, and this is your daily market brief. During this session today, we will be unpacking a firmer US dollar, a South African rand caught between global forces and commodities, a volatile natural gas market driven by liquid natural gas demand, and an S&P 500 that's quietly rotating under the surface. As stated, please feel free to ask me any questions in the chat section or comment section at any point during this session. These three instruments have one common thread: changing conviction. Let's start things off today locally, where global macro meets emerging market reality. So at this point in stage, the US dollar index strengthened above 97.5, reaching a near 2-week high as markets adjusted expectations around Federal Reserve policies. We also saw one of the Fed governors made it very clear that inflation progress has stalled and that rate cuts are unlikely until price pressure eases, shifting the focus away from labor markets and towards inflation persistence. Now, that message was reinforced, and ongoing discussions around Kevin Warsh nomination as Fed chair, that a Warsh-led Fed could prefer a smaller balance sheet and a slower, more cautious pace of rate cuts. Now, on the data front, the picture was relatively mixed. So we saw that ADP private employment growth came in well below expectations, but US services activity exceeded forecast. For South Africa, recent strength has been supported by a rebound, as you know, in precious metals, particularly gold and platinum, which are our key export drivers. However, the tug of war remains relatively clear: a firmer dollar on hawkish Fed signals versus commodity support and improving local fundamentals. Now, when we have a little bit of a look at the charts today, here we go. USD ZAR is currently trading around 16 Rand 14 cents and recovering modestly. Okay. Now, we do have resistance sitting just here, which aligns with that 200 4-hour EMA. So that's 200 period EMA, if we can put it in such a way, which is currently sitting at 1631. And that's obviously followed by this higher resistance up here at 1690. Now, on the lower end, we have support that is currently sitting here at around, let's call it 1595. And then we've got this lower support still sitting quite strongly down here at 1540. Now, on the larger time frames, momentum is still very bearish. It's still that nice slope. Yes, there is some turning that is happening in the market, but no real conviction. I mean, daily time frame, you can see here we are just retesting that 21 EMA as we've done multiple times. Even on the 4-hour, just testing that 100 EMA as we've done multiple times. So there's no clear conviction yet with regards to a move lower. So yes, this pair recently dipped below its lower range, which is increasing bearish bias, but dollar strength has slowed that momentum for now. This is in essence, a market being pulled in both directions, but neither side is fully won yet, if that makes sense. So if we do drop this down to a lower time frame, I'm going to go down to around a 15-minute. There are some, even on a 30-minute, there are some shorter term options for us here at this point in stage. Even if I just pull this across, we can see we've got this 1640 that is sitting just here at this point in stage. So From a intraday perspective, there is a possibility for a little bit of a retest at 1640. So that would require a bit of a break above the 1690 level. And that could set you up for a short-term long position. Again, I won't trade this for a longer period of time, but you could get roughly a 1 to 1.5 risk to reward ratio just on that little setup. Just taking it from their stop losses below these low points and then trading it higher to that 1640 level. Again, once price action obviously allows for that. Now, if price action never actually breaks higher and it does break back lower, and then I would wait for a break of the strong low sitting here at 1590. If that level gives way, you can obviously then start looking for some short positions, aiming for, I would say, this low point firstly here at 1565, and then trading from there onwards. If you are seeing something different at the moment, please share it with me. I would love to discuss it. If you agree with what you are seeing, you can let me know as well. Moving on, and when moving on, let's talk a little bit about energy, specifically the market at this point in stage that is refusing to stay calm. US natural gas, which climbed nearly 5%, trading above $4.50 per million British thermal units, driven by one main factor: liquid natural gas export demand. And key drivers here include gas flows to major US liquid natural gas terminals, which rose to 18.3 billion cubic feet per day, near December's records. Continued global demand is also keeping export volumes elevated, and expectations that last week's Arctic blast triggered heavy storage withdrawals at the same time. Now, we also saw that production edged slightly higher. Temperatures are expected to be mostly warmer than normal through mid-February, but storage levels may have flipped from surplus to slight deficit. So, in essence, in short, supply, demand, weather, and exports are all talking at once, and none of them are whispering. They are just shouting really loudly and making natural gas become a super confusing market at the moment. So if we flip things over and we head over to the charts here, as you can see at the moment, liquid natural gas is trading around that $4.54 level, literally on the support that is sitting here at $4.50. So it's on that support, but it is also boxed in because it is on the support, but also just below that 21 and 100 period exponential moving average. We need to see a break now, okay? And that break would have to be either below the 200 period moving average, which is sitting at $4.40, or that 21 EMA, which is sitting at $4.65. So we obviously opened up this week with a massive gap. I mean, last week, Friday, liquid natural gas closed at $5.80 after having a massive rally, and then literally opened up on Monday at $4.93. That's almost a full dollar down. And if you have a look at that specific drop, that was literally a 14.5% drop over the weekend. Now, if we, and I want to add this in here. So if we box in liquid natural gas in that relative area there, and then drop down to a lower time frame, because in essence, this is where we want to be monitoring the potential for a breakout in either directions. Should markets break higher, break that high point here at $4.65, that could set us up for a very nice position to see if we can go and retest the resistance up here at $5.30. Now, alternatively, as we said, a break below this $4.35 level would actually open up the door for a push much, much lower, and that could drive natural gas prices to come and retest these early January lows, which we saw here at $3.60. So definitely some opportunity here at the moment, definitely pushing in various directions. And in essence, please just remember that when trading natural gas, this is not a sleepy market. It's one where momentum can build really, really fast. And I think we can all see that. I mean, just look at this where it just all of a sudden shoots up. So there's definitely a lot of momentum that can build extremely fast on this pair. But as you can see here as well, it can unwind just as quickly. So when analyzing this specific commodity, when looking for some trade opportunities, please always ensure that your risk management is on point, as you do not want to get caught on the wrong side of the market with this specific instrument. Again, if there's any questions, please feel free to ask. I am here to help. I'm here to assist. And I'm here to see if that I can help you with your trading as much as possible. However, if there is none, then we are going to switch things over to the S&P 500. Now, wrapping things up with US equities, where the headline index hides a much more interesting story underneath. So, the S&P 500 has slipped relatively modestly at the moment, while futures have edged higher. Now, after 2 days of heavy selling in technology stocks, the backdrop kind of looks as follows. We saw software and AI linked names come under pressure in the last few days. We also saw that concerns grew around AI investment costs and business model disruptions, and earning reactions reminded investors that good results don't always mean good enough. At the same time, we saw the Dow Jones rose as capital rotated into more reasonable valued sectors. And we also saw that dip buyers stepped in selectively, not necessarily aggressively. Adding to the cautious tone, the ADP report was released yesterday. The report showed that private payrolls growth slowed sharply, reinforcing signs of cooling labor demand. This instant panic selling came into play, but in essence, in my opinion, it's not just panic selling. It's rotation. It's markets moving out of more high risk stocks into more constructive stocks, if I can put it in such a way. So money isn't just leaving the market. It's just changing seats. Okay, I hope that makes sense. So money is still there. It's just changing seats. It's just moving to another type of asset or another type of sector within equities. If we have a look at the moment, just want to neaten that up. If we have a look at the moment at the charts, the S&P is trading near that 6,877 level at the moment, sitting just below recent highs. Now, from a structure perspective, the index remains within a broader uptrend. Short-term pressure does reflect sector rotation rather than a broader sell-off. And if we have a look here, we are currently sitting just underneath the resistance, which is currently sitting here at 6,920. And that is obviously followed by that all-time high up here at 7,015. We also have near-term support here at 6,820, followed by the lower support here at 6,725. Now, dropping this down to a lower time frame, this has been giving great trading opportunities. I mean, if we just here on a 30-minute, even if I drop down to a 15-minute, you're going to see the same thing. But since early Jan, we've literally just been trading this range. And if you've been accurately capitalizing on bottom of the range, top of the range, bottom of the range, top of the range, and now we are back almost at the bottom of the range. Now, just looking for either at the moment, we could see a break here below that 6,868 level, which could then come down for a retest off the bottom of the range at 6,828. After which we can start looking for price action to start showing signs of reversal. I mean, here you can see came down, reversal. Here you can see some consolidation, reversal back down. Again, coming down to these lower levels, showing strong bullish candles and then pushing back up. So again, and it's been going like this for the entire month. So if you just stay within that range at this point in stage, that could be a relatively safe option and a safe environment to test out some range bound trading strategies. Now, just obviously every range bound trading strategy does have that end, and the end normally comes when markets break out of the range that you are currently trading in. So that would either be a break of the all-time high or a break below 6,820. So just keep an eye on that and don't get caught on the wrong side of the market when it comes to that as well. Okay. Again, if there's any questions, please feel free to ask. I'll be happy to answer. I'll be happy to assist. So, in essence, from my end, here's the setup going in today. Okay. If you are monitoring any of these markets or even any market that is related to these markets, just keep the following questions in mind. With regards to, does the dollar strength continue if inflation is staying sticky? Secondly, can commodities keep their footing as weather and demand kind of battle it out at the moment? And then does equity rotation turn into something bigger, or is it just going to quietly fade away? Now, this is definitely answers that we need to get within the next few days as we see whether these moves that we are seeing is just a reshuffle or the early stages of a deeper change in market leadership. That being said, traders, that brings us to the end of today's market brief brought to you by ATFX Africa, the broker that gives you an edge in today's markets. If you are not trading with ATFX yet, simply head over to atfx.com and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.